Hello, everyone. I'm John Soroka with Soroka Brand Development, and welcome to our webinar today to discuss what's new in the mortgage industry to assist lender growth and efficiencies. The Mortgage Innovation Committee is dedicated to helping prepare members and the mortgage now and in the future. Today, we're going to discuss mortgage technology worth looking into that can help your business grow and increase your operational efficiencies in a shifting market. So with us today, I am thrilled to present to you Ike Suri of Funding Shield, Philip McCall of ACES Quality Management, and Rohan Tagra of Azimuth GRC. So everybody, as we go through this, please submit your questions and I will direct them to the right individual as they come up, or you can wait until the Q&A time at the end as well. So with that, over to you, Ike.
Thank you, John. Welcome, everybody. Nice to see you, Phil, Rohan, and Samantha behind the curtains with us. So as John shared at the recent MIC at CMBA, the committee talked about what's new in tech and where is it that originators in the industry can benefit from next that we're not talking about. And obviously, it brought this panel together. My good friends, Phil at ACES Quality Management and Rohan at Azimuth are veterans in the space. And of course, I'm CEO at Funding Shield that's been managing a business that helps vendors manage risk, compliance, fraud using fintech, and try and be not a tech debt, but a tech partner that helps save costs and bring efficiencies. I wanted to set the stage so that we can have a healthy discussion around this topic in a sense where it's no longer about aggregation of data. It's about helping improve asset quality, helping improve efficiencies in an environment where the volatility on interest rates, the volatility in the markets, the chaos, especially today where it's going to be quite interesting to see where Fed funds land and how it's going to affect the market. And in an environment like this, how do mortgage originators and others in the business manage troubled waters? And you're caught in the middle of these efficiencies where you might be busy on tech improvement on the front end. What about where the most painful points are? And especially in an environment where volume goes down, risk goes higher, and regulatory compliance comes knocking on the door and fines are pretty heavy. How do you handle that? So we're going to talk about that. And Phil, how are you guys looking at ACES with these challenging markets? It'll be interesting to see and hear from you on this. And then obviously with Rohan.
Very good. I think first thing is if we pop in looking at the impact to the borrower, I think that's a piece that we're always looking at, and it's real. We're all seeing what's happened here, and if you look at the difference of what a P&I payment is for a loan, average loan for last year $453,000. You can look at where rates were all-time low back in January of 2021, and then our average rate for all of 2021 2.93%. And you can look at where we are last week and some pretty healthy increases there in those payments. And what we've seen is definitely a big drop in business overall. The MBA forecast right now, they're showing overall originations, they're down, about 37% from last year. So that
how does that affect quality, right?
Absolutely. I think this is where it comes into is this impact is transferring right over to the lenders. And to start that piece, we're going to go into, well, there is huge competition for the limited deals of what we had last year and 2020 even. There was a lot of deals, and now you're going to get into that point of fighting for every deal and lenders pushing the envelope. Historically, these are the times that we see that the ugly F word, fraud starts to creep up, where you got people that are pushing the envelope. And they're trying to make deals that maybe shouldn't be made, but they got to get it closed. They got to get something across the finish line. And with it is really imperative for organizations to be looking at that and understanding that we got to be cognizant that there's going to be some bad actors that are getting it out and really try to play things to make deals happen so they can get them finished and across the line. So that kind of starts it. I look at the next effect is what's new. And the sales and the ops teams, well, they're going to be pushing and rolling out new products. That's going to be one reaction. We're already seeing it with the amount of ARMs that are coming out now, and people saying, all right, we need to do something different that would be able to get these more qualified. Still kind of got more qualified payment increases we have. So where the buy downs come into effect, the adjust new products that haven't been prevalent for a very long time really start to come back out. And with it, being able to manage the quality, you're going to have new eligibility requirements. You're going to have a new process that your teams really need to work together cohesively from sales, ops, into your quality risk areas to make sure that you really are paying attention to all that's going on and being proactive in that quality initiative as you are bringing out new products and new lines of business you're trying to get through. I guess, as a piece of that, I'd look at, over these last couple of years, seeing, that huge outflow of resources and money's tied to really that front side origination, your POSs, your LOSs. And I think you look to this where everybody's trying to scale back a little bit. It's definitely a time to look at your back end into risk. And what's going to get me now when things are changing and so dynamic? How do I make the proper investments in my back end systems to be sure that we're safe? Because the only way you're getting to 2023 and 2024 is to make sure what you're doing right now is safe and keeping that all going and really being able to manage your manufacturing defects across the line with all this new product and new changes going on.
Wonderful. What about you guys also publish a quarterly newsletter in the industry talking about what's going on as far as trends, loan defects, focus on loan defects? What can you share there that you guys are currently observing?
Yeah, I brought a couple slides here, just a little bit of an excerpt of what we have for some critical defect rates. And Sam, if we pop to the next slide, we'll take a look at here at critical defect rates. This is a trending here that we have for 2 years. We're going to get 2020 and 2021. And where defect rates, they really spiked in 2020. A big piece of that was we all were feeling it. I mean, there was crazy with business that was going on. And as you look through that, I mean, all the craziness of the pandemic, influx of business, suddenly people working from home, not being able to get the normal, process that you've been using for years to even handle this business, we saw that. And then it started to come down as business started to get, I'd say, under control and where we're working. Historically, a 2% critical defect rate is kind of that buffer. You really always want to keep it under the 2% mark. When you get above, you're getting a little concerned. And we can see through 2021, we've actually managed to start bringing that defect rate down, and it'll be something to watch as we start introducing all the new products, all the new programs that we're going to be initiating here through 2022, how we track that defect rate to make sure that we don't start looking at that creeping up process of getting back over that 2%. Now, on the next slide, kind of broken that down a little bit further to be able to look at some of the defect categories. And these are all classified by Fannie Mae taxonomy. And, looking at this, and they're in alphabetical order coming across, the key, the core underwriting related categories, assets, eligibility, credit, income, employment, they make up like 65% of all the critical defects that we're seeing across the line. So when you want to look at that concentration of where you want to really put some efforts for your pre-funding quality control, your targeting audit that you're looking to do, really paying attention there with, I'd say, income and employment really standing out. It's surprising to me when you look at 2021, watching defects increase in that category, understanding that 2020 was crazy. HR departments were now no longer in an office. They were working from their home. People couldn't get documentation. There were all these hurdles trying to get through. This is one that, 2021, life was starting to get back to at least a routine that people could work through. And seeing that defect continue to creep up is one concerning that overall within the industry, we see a lot of money pushed towards the technology arm of how to cure these income and employment verifications, the validations, the automated systems. And with all that, still seeing an increase in defects, something definitely to keep an eye on, make sure internally that you're watching it, because these are the areas that will come back to get you.
Hey, Phil, quick question on that. What on this, you mentioned the systems. What are you seeing from a systems perspective, right? Because, there's more and more automation here. and people set up their stacking documents, and I'm looking at it from the investor perspective, because we're seeing a lot of those documents not included, and we think it comes back to how they're using and maintaining their LOS systems and the documents that they send up. Any feedback there?
Yeah, absolutely. I think you come into that, and actually, if we pop to the next slide, it'll be a good one to talk to, because this is some Fannie Mae data on their actual categories of where they're seeing their top defects. They're a little bit dated in their time. We actually just had someone at our user conference here back a month ago, and they're seeing the same thing. This income and employment, definitely an issue. And you look at number one, income not properly documented, self-employed. And you got, GSEs looking at this saying, all right, this is a big problem. And you get into borrowers not employed and undisclosed liabilities, incorrect income calculations, self-employed and rental income loss. So their top defects all around this employment and income process, whether it's documentation, calculations of what you're looking at, it is a key one. And Greg, I agree, it's down that line there of what systemically are you putting in play where your system can drive efficiencies, and how are you identifying, and then corrective action plans. It becomes a huge part of when you identify these defects. I think that tendency is there's a lot of band-aids. We fix it. It's okay, but you're not fixing the root cause. So you continue to have these defects that, we'll call them, a lot of gross defects. You're able to fix them, but the more of those you're trying to fix, ones are going to slip by and become the net defects. So how do you install that root cause assessment, action planning, so you correct it for the long run?
Yeah, I think also, right, and coming back to that second order, it's not set it and forget it, right? When you set up your system to deliver the set of documents to whoever, investors, Fannie, Freddie, whatever the case may be, if you don't control that and allow your people to create new document names, for example, and then they don't get it added into the doc set, then you're exacerbating the problem the more you let that go. So I think it takes key management there.
Absolutely. And I go to that. I think I try to keep this overreaching kind of community feel that the whole team, and that's your whole organization from top down, has got to be vested in this process, and understanding that it's usually on your compliance, your quality control team. They end up cracking the whip and being in the ones, but if they're proactively involved as you're making changes and you need new documents, how are we checking? How are we updating those systems to make sure that it doesn't get to the end? And that's what we find so much is the involvement isn't until it's over. And it's like, well, that was too late. We should have been engaged early on. We would have made sure that we had these corrective measures in play before we started shipping this new product or these new document requests, whether it's a new investor or just a new product line.
Yeah, and I think you find, and for the other side of this, right, the income documentation is also the most highly cured finding they have, which means that the documents are there and they were collected. They just didn't get delivered to where they need to be.
Correct.
Yeah.
It's something Fannie Mae's been talking about is they're really going to start really looking heavily at the gross defects versus your net, and concentrating on these gross defects and looking at some type of a grading scale that's like, you've got to reduce the gross. You can't just keep fixing them. There's so much fixing going on, and that's kind of the laughing definition of your net defects. It's like, well, everything I couldn't fix. It's like, okay, we got to bring that gross one down and not have so many things that have to get fixed.
Yeah. Well, Phil, if it's okay with you, maybe we can have Rohan come in and share his currently observations, what they're dealing with in the market, and how they're helping the industry with Lasmits.
Very, very good. We can go ahead and pop a couple slides there, Sam, and let Rohan pop in.
Sounds good. Thanks, Phil. That was very insightful. Ike, thank you for hosting and having us, and Sam and John. So I'll talk a little bit. We've got some slides here, and some I think maybe for reference, and some maybe just for the discussion around what we're doing. I think the big thing that we're seeing in the industry and the fundamental shift that I think we're trying to work through is sample testing versus full population testing, and truly understanding your full portfolio. So what we've got products that around this, but really when you think about the concept of what the industry is seeing, it's around truly understanding what's happening within the portfolio, whether that's on the origination side or once the loan is originated and then goes to be serviced, and you've got to manage that through. So as we've all seen, the regulatory scrutiny has been heightened quite heavily. The new administration and the new CFPB administration, we're seeing is, a lot more, not just supervision, but enforcement. I think every day we're seeing different articles from the reach into the fintechs to, if you saw the American Banker article today around Fifth Third. And so there's just a number of those things that are out there. But what we're focused on is what can cause these things is you think you've got comfort around knowing your portfolio, knowing what on the origination side or the servicing side, based off of doing sample testing. So if you think about if you're going to originate 1 million loans in a year, I know those numbers sound large, or you're going to service 1 million loans, what's generally accepted today is 95% confidence interval and 5% error rate. So if you think about what that means is on 1 million loans, and I love asking this question. So I know the panelists can respond, so I'll throw it out there. Guess how many loans you have to test? And Phil probably knows the answer with this because of ACEs, but how many loans you have to test to get 95% confidence interval and 5% error rate on 1 million loans?
I wouldn't know.
380. Oh.
Go ahead, you give it up.
All right, 383. So
Wow.
you think about that, right? That means you got 999,617 other loans or transactions that are unknowns, right? And so that's why when you think about in this environment or in this world today, you go through your testing, and the compliance testing groups are large, QA groups, QC groups, check the checker work. It happens a lot and through the process. And I'm sure this helps contribute to some of the fraud issues you're going to talk to us about. Ike is working through that piece of it. But that's what we're seeing in the industry is this, the old way of doing this in terms of testing and validating what's happening within your portfolio isn't working because you do that piece, you think you're covered, and then someone comes in and looks at a different population and it doesn't yield the same result, right? And so that's where the issues come in. And so what we've been focused on is, changing the paradigm to do full population testing. So literally testing every one of those 1 million loans for each of those regulatory compliance items or operational items that need to be covered through. And so when you think about that, what that changes is the paradigm of knowing that not just your portfolio is right, but every customer is getting treated fairly and equitably.
Right.
So, think about credit bureau reporting on this once the loan's boarded on the servicing side. You go through that and you provide a monthly report to the bureaus. Well, if someone does not get their credit bureau reporting correctly, that's going to impact their day-to-day life. It's going to stop them from getting an apartment or rent a house, credit card, a loan for a mortgage or for a car, right? So those things can be meaningful and material. But when we talk about an error rate, we had a 2% error rate. That looks pretty good. But on 1 million loan portfolio, it's 20,000 people that are impacted. Mm-hmm. So when you think about and you make it real in terms of how does it reach out into everyday lives and people, that's the paradigm shift that we're seeing is this old way of doing the testing in terms of the number of things that you can look at because you're limited. If you're limited by people and manual processes, then that's going to impact how much you can do. So I think that's one of the big fundamental changes that we're seeing in the marketplace is from what we can cover. And now I think the technology is getting to that place where that's becoming not just inevitable, but an expectation.
Right. Wonderful.
And I was just going to show one example of something that, a difference of what you can show. Sam, if you wouldn't mind flipping down a couple of slides. There you go. So this is the one that talks about through technology, what you're able to do is what you do manually today with a handful of folks that you might look at a sample of 30 or 50 or 80. And it's going to take you, a number of people, a handful of days and what you can cover. And so again, this goes back to knowing a little bit about your portfolio versus if you go through and do the full population, because you've got the way to do that, Now you understand every in and out and where you need to go focus on to remediate or even identify those issues, those resolutions prior to it going out the door, right? So, if you can solve it before it goes out the door, then it never hits the defect rates that Phil was talking about. So I think that's how it ties into minimize or mitigating those defect rates.
So I have a question for you, Rowan. It'd be nice if you share the definition of your company's name, the meaning, azimuth. Isn't it knack of doing things or doing them the right way?
Yeah, so there's two pieces to this. It's a long story of where the name came from. When I was first starting the company, there were others that were going to join. One of the folks that was thinking about it when I was at JP Morgan had done 2 tours to Iraq, and azimuth's a big military term. Means
Yes.
true north, keeping you on the right track.
Yes.
And so it had that, and both my kids' names start with a Z, so we had to put a Z in there. So and it aligns with our mission, right? It's true north, keeping you on the right path. And so it all fit together, and that's where it came from. I know you've got a story behind azimuth too, don't you?
I do have a portfolio company called Lasmits for the last 30 years, and the another definition of that is very similar to what you defined in military, which is doing the right, staying north and staying in the right path. And a knack of doing things comes naturally doing the right way. So it's a great name to what the purpose of the company is today. And I found it was something when we first spoke, it stuck to me and it's in my head. So this slide is amazing when you look at, 5 days worth of time being reduced down to 20 minutes. It's just, this is an environment where everybody's looking for this, how to take down tech expense, tech debt, and deal with these markets with this kind of efficiencies, which have been overlooked for quite some time. And this seems to be the right market to advocate and raise awareness and see where it can help the industry. That's brilliant. It ties into, and I'll plug in on Funding Shield's behalf as far as, we at Funding Shield are all about verifications and managing risk against wire fraud, title fraud, and representations being made by stakeholders at the closing venue. So we don't necessarily participate until when it comes to that closing venue, and we are the third-party oversight, making sure that everything that was recorded or collected or rightfully collected from the right parties and so on is exactly the way it needs to be. For example, as wire account info for the licensed intended party, not just a party. Having a license to operate in the right jurisdiction, and attorney states are quite complicated when it comes to that. In that experience, we also publish a quarterly report similar to ACES and to Azimuth, and we published one early this year. It talked about 1 out of 3 transactions had exposure to risk and fraud and neglect and mismatch. And that percentage is seriously high. And it just is scary to see that's what's going through, if not being really verified and tested for the interest of not just the borrower, but also the investor coming in, picking up portfolios where the asset quality is not good enough or not great enough. And repercussions on these frauds are seriously high. So the efficiencies there kind of match with what ACES, Azimuth, and Funding Shield are dealing with for the market in the industry today. Phil, I know you had a slide that I might have pushed forward where you had to skip it. You're welcome to address if there was suggestions on as to what should lenders be looking at in order to, help them with the quality of work going through. There were some other trends you were going to share.
Yeah, we can talk to it. It definitely was into a point. I think actually it really kind of touches into a little bit about what you just brought out. I want to kind of drill into that a little bit as we go in and you talk about that type of defects that are being found. What I wanted to end out on the quality side is really that focus of what we're going to be looking at into the near-term future here, and the average borrower profile that we're looking at. And some new numbers even just came out yesterday, day before, that were main numbers looking at, the qualifying box is expanding, which we're seeing FICO scores starting to drop a little bit, and that lower average FICO score DTIs are getting pushed up a little bit, LTVs getting pushed up a little bit. And when you look at this, it becomes that piece of this layered risk. And any of us who were around for the 2008 type of meltdown, well, that was layered risk to its ultimate just disaster. This is not the case that I'm saying at all, but it's something to pay attention into quality when you start pushing. You're pushing your DTI up a little bit, your LTVs up, credit scores down. You have a lot less room for corrective action within that to have loans now suddenly be non-saleable. So as we are looking at this bucket, it's going to expand. We have fewer borrowers that can qualify. So being able to push it, it is being diligent on how you are looking at your layers of risk and underwriting. And again, some of those key areas we saw before are going to have even more focus and stress on them of what's happening. And we get into the market of refis. We rode some pretty easy markets with your rate and terms, your streamlines, your IRRRLs. I mean, it was just a lot of easy originations going on with not much underwriting needed into those. It was some pretty basic stuff. And the refis that are going to be left, hey, they are going to be tricky. Cash out is definitely going to be there. There is a lot of untapped equity in the marketplace right now. One thing with our great market, we've had such appreciation. People are going to want to pull market out. Pull equity out. So as you get to that, it is a point of, all right, the underwriting for getting that cash out, making sure you're making prudent decisions. Looking at the alternative products that we're going to see. I think we already started to see that HELOC market. I know I keep getting now mailers for HELOCs from the banks that suddenly are back into doing HELOCs. They want to, and I think a lot of the lender community, it's going to jump back in. It's like, hey, we're going to offer some HELOCs. We're going to close end seconds. New product lines, how can we help borrowers, get into that equity, debt consolidation? How do I make sense of it to work through? So I think as you look at that with these changing times, again, it's back to making sure that your risk, your QC is all involved in managing that and proactively pushing forward to keep everything up to date and in good shape. And kind of last, and Rowan, you touched on it with CFPB and their engagement. It's there. They're going to be a part of the life. They're kind of, they've reinvigorated here as of late. And, Director Chopra, when he was testifying Senate Banking Committee late April, definitely had a clear message to servicers. And remember, you've got a lot of good data on your servicing type of reviews. And I think it's really key that entire population testing. It's something that the whole market's moving towards, and you've got to be able to do it. And knowing that, CFPB now really working into the auditing platform, they're going to be in a lot of shops this year and next year. And with it to really be cognizant. And even on a second level, CFPB is really, opening welcome arms to the states. Hey, you need to start your own platform and programs and start getting after this review and auditing process. And for, any of us from California, yeah, you're working with California, but you're multi-state. It's not going to be out of realm to sit there and go through 20, 25 state audits that are going to happen per year. All of them doing a similar CFPB type of thing. So, in the whole, this transition period we're in of craziness, it's like the audits are even going to get tougher and that scrutiny. So that was kind of a piece of looking there. And ICO, it really makes me think of that type of defect identification that you're seeing on that funding side, which couldn't be more critical. I mean, this is, you're talking a whole lot of people at risk. Where do you see the bulk of those types of errors happening? And hoping it's not the fraud. And I looked at, boy, what could get worse now in these times that are getting a little tighter and tougher? What are you all seeing and planning to institute to help people be safe?
Sure, great question, Phil. Thanks. Recently in the last month, we were at the MISMO event in South Carolina last week, and there was discussions around this as well. And there was a lot of good panelists from large banks and servicing companies, and obviously Seth Appleton over there. And the discussions were about tech. And I was asked the same question. One of the things, and you may have found it happening to you guys as well, Rohan and Phil, where service companies, more and more service companies are reaching out and saying, I want to collect this before closing so that the asset quality coming in is already lined up with me, so we have an easier path in the future. So they're reaching out saying, you're just before closing, we'd like to see where is it that, at least at the closing level, where the verifications find fraud. The idea of staying ahead of the game is to find, detect, protect. And that's why we can't necessarily call it fraud all the time, but our idea is to prevent the fraud. And in that, we break it down, we delineate, and we've seen a lot of exposure with CPLs and bank reference letters and jurisdiction and E&O policies, insurance coverage. These are the top 4 or 5 ringing alarms, and there's so many repeat offenders too. And in a market where everybody's so busy, lots of people try to cover that, but the companies don't have resources to check every loan. Automation helps. And then past that point, when the volumes are down in this chaotic market, the risk and these frauds only go up. There's an inverse relationship. Those bad players are looking to, their numbers start looking bigger and larger because they have to go find more volume to deal with. And so fraud is only going up. And like you rightfully pointed out, with Director Chopra's stringent oversight coming in to enforce things, it's going to force folks to put their arms together and get cohesive with, we've had a lot of innovation in mortgage tech in the last two years during COVID, where all this needs to be cohesive and collaborative and transitioning seamless with each other. That is the goal. Everybody talks about it: safe, seamless, secure. And it's happening with these pieces that are now coming into limelight about inefficiencies in compliance, regulation, and risk. So it is the right time. And that's what we see, Phil. Hopefully I answered your question. So are you guys also hearing more and more from the service companies reaching out, coming ahead of the game rather than waiting for the business just to come to them? Yeah.
Not something we're seeing, but and again, it's a piece of testing that would come in where we're not in the actual files of working through. So I think a missing step that I've had a bunch of our clients that are seeing that type of activity and dealing through it.
Yeah, I mean, we're seeing, when you look across, it's being detective, like you're talking about, Ike, across the board, right? Whether it's on the origination side, ensuring that there's not fraud there, whether it's on the servicing side and making sure, whether it's fees or credit bureau reporting, or now when you start looking at, CARES Act ending and you've got the forbearance period over, and now that's moving into what's the right, loss mitigation strategy, what's the mod, what's going to happen there. There's a waiver from the CFPB that says you can not get the full package if you, waive all certain fees in X, Y, and Z. So are those things being done correctly?
Right.
So I think there's a bigger focus on not coming in after the fact, but making it more part of the operational part to ensure these checks are happening along the way. And again, the volumes are going up, right? It was originations, but now it's going to be, there's a concern around what may happen on the default side. So those volumes potentially are going up. And so now it's mitigating the risk on that side. And in turn, it's covered over there as well. And 100% we're seeing, the focus that the CFPB is putting is translating down to the clients, and the clients asking for, hey, what are all the things that we can do from a mitigation standpoint and managing that risk and compliance of reg risk?
Yeah. Well, all firms have found a way to present their product where it shows that these services provide an ROI. And I saw in one of the slides, as you shared, 5 days of work being put together in automation in 20 minutes. Phil, you want to share as to some of these efficiencies, what those ROIs look like? Be useful for folks that are listening to us or will be listening later on a recording.
I just want to, that was the work of 500 people in a year that we did in 20 minutes.
That's right. I'm sorry. And there was another tab that you had that said 5 days and much smaller time.
Yeah, we were just comparing just what's being done in terms of volume coverage. So you're getting 99% more volume coverage in 1% of the time. So it's a massive amount of efficiency and ROI that comes. And then there's always the concern that we're hearing about as well as, okay, now I find all of these things, what I'm going to do with those. So then there's also a piece around putting governance in place to make sure, the right approach of how do you handle these things and deal with them at category levels or bucket levels and put remediation strategies, which are, and then looking at things in terms of, is it a process issue? Is it a customer issue? Is it a data issue? And then working through it that way. So not every issue is created equally, right? There's different ramifications of those.
Yeah. Well, that's a huge ROI right there. That's humongous. Sorry, I didn't mean to say what I did say, but I did see the slide and I wanted to point that out.
It's a little shocking, I know.
I think when it comes to any of the technology, it really, you have to provide a solution that is curing a pain point and provide an ROI. And
Yes.
as you look to that, I think from every lender and servicer out there, they all answer to a higher authority. And whether it's the GSEs that who you're providing services for, it's the CFPB or other regulators, they have these requirements and rules that they are imposing on you that you must complete. And being able to do that work in an efficient manner, I mean, that becomes a technology solution. And
Yeah.
you're looking at entire population testing, you're looking at statistical sample testing that you have to get into. You got to meet their requirements. And I know it's a big piece that we try to work through is keeping really tight with the GSEs, the agencies on the regulatory side of making sure this is what they're auditing, this is what they're coming after. You need to be proactive in that and make sure that you're doing the same thing so you're not surprised. So when they come in, that's what they're looking for, is that diligence. And to build that ROI around it, I think it's a part of what we do every day is being able to provide that. So this is where your return is coming to you. And it's always tougher on, I think for all of us, we're all dealing on, let's say, non-revenue producing items right now. This is not going out and getting you a new borrower. It's all about revenue retention. How do I protect you from losing that money and having it either via fraud or penalties or fines, whatever it may be? How are you keeping this your revenue intact and not losing from that quality? So it's always a challenging one on the backside to make sure the organization and you move up the chain that there's an understanding to the risk factor, and that risk is real, and at certain times it becomes more real, and in times like that with changing, it's like, okay, it's even getting more severe, where you got to look at that risk tolerance of what you're looking at for these next 12, 18 months. Where do you want to land?
Yeah, I've learned a lot in my journey in this space, in the sense that, as you rightfully put, non-revenue product. In a market like this, it's in limelight where, everybody's been so focused on operations. And when you're selling a product like this in compliance and risk, which has become more and more important in this market, ahead of this, when selling that product, the attention span you get from the vendor manager or the risk team or the ops team is not in line with the budget and the treasury team, right? And in this market, they're all talking to each other, looking for an ROI, looking to mitigate risk and compliance. And this product is not all that exciting from what I've learned, and I don't mean to undersell or oversell, but it's a boring sell of a product where everybody's so excited about originations and returns. And the returns are coming from a product that has had not that sexy of an appeal, but is in vogue today. So it's the right time to be in the market to share, and the industry's looking for it, where innovation is happening. And I think that was the key point of this panel, to talk about what everybody's looking for exists today. And you just gotta, CMB is doing a wonderful job and giving an opportunity to firms like ours to advocate and create awareness. So we appreciate that, John, Greg, for the opportunity to be able to share what's going on in this space. Any other questions come to you, John, perhaps, or Greg?
None to me, thank you.
None to me.
All right. Well, I think it's been a pretty decent chat. We might be a little sooner than the time we've got, but maybe you want to open up for questions if there's some now, and if not, we can respond to them on email and so forth.
Samantha, do you see any questions coming in?
I haven't seen any questions coming in, just some comments on a job well done for all our presenters. So thank you guys for being here. As a reminder, if you do have any questions, please post those in our Q&A dialogue box, but I haven't had any come in yet.
Okay. I bet you everybody's on summer break, just like my kids.
Exactly, yes.
So we're going to be sending out a survey to everybody that has attended. So if you could please reply to that, let us know what you thought, and if you have any ideas for future topics you'd like for us to cover, let us know that as well.
Wonderful. Thank you, everyone. Thanks, John,
everyone.
Greg.
Thank
And
you.
Nice
Everyone,
job, all.
guys. Thank
All
you.
right, thank you all.
Take
Thank
care.
you.
have a good
Bye now.
guys.
All right.
All right. So long.
Take it easy.